In today's lesson, we're going to continue talking about Chapter 2 and job costing. Our focus today is going to be on overhead. Remember in the previous lesson, we discussed that overhead is applied to jobs because we're not going to have all the costs until the end of the year, and we can't really wait that long to determine if a job is profitable or not. The way we handle that is by applying overhead. Today, we're going to focus on our predetermined overhead rate. This is the rate that we're going to use for when we apply overhead. To calculate the predetermined overhead rate, we're going to take our estimated overhead and we're going to divide it by an estimated base. Base is a pretty wide range of words. It can mean anything the company wants. We can use direct labor hours, we can use direct material cost, we can use machine hours, we can use equipment hours, we can use anything the company decides. The good news for you is every problem will tell you what the company's basis is, so it's not something that you have to decide on your own, so that's a good thing. Once we have this predetermined overhead rate, notice this is always calculated using estimated amounts. We're going to actually apply the overhead to jobs. When we apply the overhead to jobs, we're going to use the actual amount of whatever base was used in the predetermined overhead rate. Again, the actual amount of the base for that job. And then we're going to multiply it by this predetermined overhead rate. It's very important that you understand that applying overhead is not the same as actual overhead. What we'll do is we will compare actual and applied at the end of the period and determine if there's any adjustments that are needed. Let's look at exercise F. Over here you can see exercise F, and it says that different companies use different bases in computing their predetermined overhead rates. We are using rock, paper, and scissors as our companies. We're given the estimated data for them. And it says the basis for determining predetermined overhead rates. Paper uses direct labor cost, rock uses direct labor hours, and scissors uses machine hours. Our first step will be to calculate the predetermined overhead rate for each of these companies. The first company is paper. We're going to take their estimated overhead, and we're going to divide it by an estimated base. What is paper's base? According to the problem, paper uses direct labor cost as the base. So I want estimated direct labor cost as my base. So my estimated manufacturing overhead, remember we use the terms manufacturing overhead, factory overhead, or just overhead, all mean the same thing. So we're going to look in the blue column. The manufacturing overhead cost for paper is estimated at $400,000. We're looking for the direct labor cost for paper, which is $800,000. So my cost is 50 cents per direct labor dollar. Or you could also say this is 50% of direct labor cost. Either way is fine. To say it's 50 cents per direct labor dollar or 50% of direct labor cost. Okay. Next, we have rock. Rock has a predetermined overhead rate based on direct labor hours. So rock is allocating overhead on the basis of direct labor hours. So we have our estimated overhead, and we're going to divide that by estimated direct labor hours. We'll use the blue for the estimated data. We'll go to the manufacturing overhead cost for rock, and they have $432,000. Their basis is direct labor hours, so we're going to look for direct labor hours. They have 48,000 estimated hours. So it's $9 per direct labor hour. So Rock's predetermined overhead rate is $9 per direct labor hour. Now we have Scissors. Scissors decides to use machine hours as their overhead basis. So we are going to take, for their predetermined overhead rate, estimated overhead divided by estimated machine hours. Their estimated overhead is $375,000. Their machine hours are $125,000. So we'll take the 375 and we'll divide it by the 125,000 machine hours, and we get $3 per machine hour. So any company can decide what basis they want for their overhead. There's no rhyme or reason necessary at this point. They can decide anything that they want, and it's perfectly fine. We will determine that at the beginning of the year so that we can apply the cost to the jobs during the year, and then at the end of the year we will continue to see how close we are. We're going to continue with exercise G, where we're going to use these predetermined overhead rates from exercise F, and we're actually going to apply overhead. So to apply overhead, remember we take the actual amount of the base times the predetermined overhead rate. We'll start with paper. Paper, remember my base is direct labor cost. So I want to look in exercise G at the direct labor cost of $850,000. So I'm going to take the $850,000 direct labor cost, and I'm going to multiply that by the 50 cents per direct labor dollar we calculated up here. So that gives me applied overhead of $425,000. Remember, this is applied overhead, or what we're calculating. In the problem, also in the green data, they've given us the actual overhead for paper. Actual overhead is $450,000, which means we have a difference, right? We have a difference here. My applied is $425, and my actual is $450. So I have a $25,000 difference. The question is it over or under applied? If applied is less than actual, it is under applied. If applied is greater than actual, we say it's over applied. Okay, let's continue with Rock. Rock had a predetermined overhead rate of direct labor hours. The number of direct labor hours for Rock, using the green chart, it says direct labor hours under Rock were 46,000. So we're going to take 46,000 direct labor hours, and we're going to multiply it by the $9 predetermined overhead rate we calculated up here. We calculated the overhead rate using the estimated figures. So once we take the 46,000 times 9, we see that overhead for Rock is $414,000. This is what was applied to jobs. Looking at the actual data, the actual manufacturing overhead for Rock was $400,000. My actual is 414, or my applied is 414, and my actual is 400,000. So we have a difference of 14,000. Since applied is greater than actual, we say it's over applied. Next, we have Scissors. My basis for Scissors overhead is machine hours. How many machine hours did Scissors have? We're going to look at exercise G's green data. Machine hours for Scissors were 130,000. So if we look at 130,000 machine hours times $3 predetermined overhead rate, calculated up here, we get overhead of $390,000. The actual amount of overhead given in the problem is $375,000. We have a difference of $15,000. Since my applied is greater than my actual, we say it is over applied. Okay, now we have identified over and under applied. The question is, what do we do with them? The goal is for the overhead account to be 0 at the end of the period. No over and no under applied. So we want actual and applied to equal. So the way that we're going to do that is with journal entries. We're going to use cost of goods sold as our offset. So the accounts we're going to use are cost of goods sold and our overhead account. We're going to increase or decrease as necessary. For paper, you can see it's under applied. Under applied means we did not charge enough to the jobs. So that means we need to add more costs. So we're going to debit cost of goods sold, and this will be for that $25,000. So we're going to take the $25,000, we're going to record it to cost of goods sold because we want to increase the cost, and we're going to credit overhead because we want to remove it from overhead. Again, you could use overhead, manufacturing overhead, or factory overhead. Any of those is perfectly fine. We're going to do the same thing for rock. Rock is over applied. Rock and scissors are both over applied, which means we charged too much cost to the jobs. So that means we need to take some of the cost out. So we will debit overhead. For rock, it's going to be $14,000. And we will credit cost of goods sold for the same $14,000. For scissors, we will do the exact same entry because it is over applied. We will debit overhead for $15,000. And we will credit cost of goods sold for $15,000 because it's over applied, which means we charged too much cost to the jobs. This is how we look at actual and applied overhead. If you have any questions, just let me know.